What is a 1031 exchange and how does a 1031 exchange work? That's what we're going to cover in great detail on today's video. Now, in a recent video on tax savings for real estate investors, I briefly touched on the powerful benefits of a 1031 exchange. So today we're going to dive deep into what a 1031 exchange is and how it works and how you can find out if this strategy is a good fit for you. So grab a piece of paper and a pen. Now, if you're thinking about selling off one of your rental properties, you should be aware that doing so can leave you with a massive tax bill. People don't think about this, thanks to the capital gains laws under our tax code. If you sell an asset for more than you purchased it, the government collects a tax on that gain, which can be upwards of thousands of dollars. But with a 1031 exchange, you can buy a new property and defer those taxes entirely. So here's how it works. To do a 1031 exchange, you'll need to work with a qualified intermediary who can walk you through this process. In order to qualify for a 1031 exchange, the properties involved in the exchange must be held for either business or investment purposes. Because I know someone's going to ask, and before you do, no, you cannot conduct a 1031 exchange in your primary residence, the place where you live. The IRS will request that you prove that your property is an investment via tax returns and records of rental income. So you cannot do that. And your new purchase, also called your replacement property, must meet some requirements as well. This means if you want to defer all of your taxes, the replacement property that you're buying must be of equal or greater value than the property that was sold. The replacement property must be like kind. Yes, like kind. In my experience, this term often creates a lot of confusion for investors. It's a broad guideline that refers more to the nature of the investment than the actual type or the quality of the investment. For the most part, any piece of real estate will qualify as like kind. For example, if you sell a single family home, you don't necessarily have to purchase another single family home. You could exchange for a duplex or a triplex or a warehouse or an office space. This exception would be anything that isn't a long-term investment, such as properties used for flipping. The replacement property also must be in the United States. Important. If you take away one thing from this video, let it be this. The 1031 exchange involves strict guidelines. This process is not something you can do sort of in a leisurely manner and hope it'll be okay. There are two important numbers to remember, very important numbers, in order to have a successful transaction. 45 and 180, okay? 45 and 180. The IRS requires that the investor identify their purchasing plans on day 45 of the exchange, and the investor has 180 days to complete the exchange and close on the replacement property. Now, the 45-day timeline and the 180-day timeline run simultaneously, and the clock starts on the day that escrow closes on the sale of the first property, also known as the relinquished property. This is the property you owned and the one that you're upgrading from, okay? These are strict guidelines, and the investor must meet both of these time limits. If you fail to identify a replacement property by day 45, or you don't purchase the replacement property within 180 days, you can expect to be taxed on the sale of that relinquished property. Seriously, Uncle Sam will get his piece. There are no exceptions. There's no extensions, none of it. You have to follow that 45 days and 180 days to purchase the property. For more on these guidelines, I've written a whole blog post about it. It's a deep dive that outlines all of this. We'll link it up in the description below. It's called The Ultimate Guide to 1031 Exchanges. There's no better guide on the internet, so you can find it on our website, and we'll have a link in the description below. Now that we've covered some of the basics, let's talk about the main reasons why you might consider a 1031 exchange in the year 2023 and beyond. Appreciation. There's a good chance that the majority of your portfolio has seen healthy appreciation over the past few years. That now makes a great time to take advantage of the 1031 exchange. It's a great opportunity to preserve your equity, keep the proceeds, the money that you would have paid in taxes, and instead use those to buy a better performing property right now. Next up, cash flow. Let's be honest. Sometimes you scoop up a property and it's a dud. I know this has happened to me before. It's going to happen to investors from time to time. Well, instead of selling off that investment and taking the tax hit for selling it, because it might have even appreciated in value, but the cash flow wasn't there for whatever reason, you can exchange it for a property in a better market with higher cash flow. Smart move. Number 3, diversification. As long as your replacement property is used for business or investment purposes, you can use a 1031 exchange to diversify your portfolio. Number 4, wealth preservation and estate planning. When you clicked on this video, I bet you weren't expecting to think about your mortality. So let's make this part brief. Using a 1031 exchange is a great estate planning tool because it allows your estate to inherit your assets. And if your heirs decide to sell those properties, there would be no capital gains taxes for them. So what type of investor might consider a 1031 exchange? Well, if you're interested in learning how to avoid capital gains taxes, you want to save on your taxes. Maybe you're looking to purchase performing assets in top growth markets in exchange for your current portfolio, which is not doing so hot. We've worked with investors at Morris Invest, which is my company, who owned some really expensive properties in California, but they certainly weren't performing. The internal rate of return was awful, and they were able to use a 1031 exchange, sell those properties, and buy multiple brand new construction properties in some of the best rental markets in the country that are now cash flowing and have a very high internal rate of return of 18% and higher. They took properties that were getting a 2% return and converted that into an 18% return. Another reason you might take up a 1031 exchange is if you're interested in making a switch from commercial real estate investing to residential real estate. This is a good way to move markets in that way. Another thing might be to seek investments that will offer a better return on investment and wish to diversify, like the folks I just mentioned out of California. Another reason you might be interested in a 1031 exchange is if you're interested in exchanging an investment property that you currently manage for a more hands-off investment opportunity. These are all great reasons. I also want to note that even though you're not actively considering selling a rental property, it's always wise to evaluate the health of your portfolio. If you haven't taken a look at your performance of your properties lately, you might want to consider using a 1031 exchange, maybe if you're burying your head in the sand about how well those properties are performing. And at my company, at Morris Invest, we'd be happy to talk to you about your goals and help you determine if a 1031 exchange would be beneficial for you. Our 1031 exchange program makes the entire process quick and easy. We can totally help you from soup to nuts. If you're looking for ways to save on taxes and you're considering selling a property, we can help you buy new construction real estate in America's best rental markets. To schedule a free call with our team, just go to our website, morrisinvest.com. The link is in the description below, as well as the Ultimate 1031 Exchange Buying Guide. We have it all right there for you to check out. And we'll see you next time, everyone.